Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. This week, we are lucky enough to be joined by two folks from Strategas, head of portfolio strategy, Nicholas Bohnsack, and investment strategist, Thomas DiFazio. So we're going to talk investment strategy today. I want to start with sector positioning because you all have been overweight cyclical sectors the entire year, really. Financials, energy, industrials, materials. Those sectors are again outperforming, and you all stuck with that call during a difficult time for those sectors. What do you think that says about the economy, and do you expect this outperformance to continue going forward?
That's a good question, Ross. We do think that cyclicals will continue to outperform, as we've talked about in this forum and others. We're at the beginning of a business cycle. We're in the process of making a transition from recovery to expansion, and although jagged, as we sort of digest the sort of global supply chain imbalances, we're at a point where business operators should start to deploy some of the increase in revenue that they've enjoyed off the bottom and through the recession. So we do think cyclicals will continue to outperform because of where we are in the cycle. I think in a more immediate case, what we've seen is that interest rates have backed up. The long end of the curve has sold off, and that type of cocktail has traditionally favored value and cyclicality over growth. And I think the market's just digesting that transition right now.
That makes a lot of sense. So Thomas, thinking about the way that interest rates are moving, is this a story of interest rates leading equities, or vice versa? Is it the outperformance of the cyclicals that's kind of determining the move in the bond market?
Well, it's an interesting debate, and one that we've fielded a lot from clients in our communications with them, both via meetings and just research requests that we've gotten throughout the past couple of weeks. We've been looking at ones such as the financials, who have been stark outperformers and have actually been leading long rates, especially the 10-year yield, to be specific. And while we were waiting for a response from yields, we were using the outperformance from the financials as our North Star to help inform our decision making in our allocations.
Yeah, I think Thomas makes a good point here as well, Ross, which is to suggest that if it were the opposite, we would expect the traditional stalwarts of counter-cyclicality to outperform, namely the staples or the utilities. And we just didn't see that. We didn't see it earlier this year when things seemed to be a little bit more frothy for the economy and its recovery. We didn't see it during the summer when things started to get a little bit more laggard, and we're not seeing it now. And that's also underpins, I think, as Thomas makes the point, our preference for financials and cyclicals in general.
That makes a lot of sense. I appreciate that. And Nick, one thing you mentioned about the supply chain issues that the economy is kind of working through. One thing I always really like about your all's work is kind of thinking through the second derivative question. So this is a well-known problem at this point. It's leading, publications everywhere you look. Is this discounted by the market? Have we reached kind of peak supply chain worry? And it's a tricky question to answer, but what do you think about that idea?
Well, it's a good observation on your part. For our money, the answer is yes, which is to say we do think it's been largely discounted, if not fully. We're certainly getting there. And if there's one sort of catalyst that will probably get us there, it's this earnings season. Chief financial officers, they went to all the right schools, they know all the tricks, and not one of them lets an earnings season go by without blaming some sort of big macro phenomena on why their numbers aren't better. And so just in the few earnings reports and conference calls that we've seen thus far, almost universally, companies are blaming global supply chain disruptions, and companies also that really aren't direct participants in the global supply chain. So my sense is that we are getting to peak bottleneck. And what's important about that, somewhat different perhaps than what we experienced in the 1970s or in other points of dislocation, is that companies are really good at managing to some of these operational imbalances. And so where we might have a quote stagflationary environment today, slightly higher inflation, slightly more sluggish growth, tomorrow that gives way to some greater operating efficiency. And as an investor, that's something we want to follow. Might not be good for the labor market in total, might not be good for other discrete pockets of observation, but for investors, companies will get more productive as a result of this. And that's one of the reasons, again, we think the economy's not going to fall off a cliff.
And to build off of what Nick's saying, we also think that as we start to digest and move past this point of peak shortages or peak supply chain issues, we can use this market turbulence as an opportunity to add exposure to those more cyclically oriented corners of the market that deserve more respect, especially with the respective price action to boot.
Yeah, absolutely. Well, I'm not going to miss an opportunity to close on a high note. It sounds like there's some opportunities, some reasons to be bullish and optimistic about the economic outlook as well. So I want to thank you both a lot for your time and hopefully get to chat with you again soon.
Thank you, Ross.
Thanks, Ross.